Start. More confusion in Argentina driving soybean rallies, the international context of those rallies for commodities, and also a very, very complete macroeconomic data that is going to be explained by Mike Zuzolo, president of Global Commodity Analytics, right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. So, Mike, we are seeing very significant rallies in both corn and soybeans. And do you think, at least in the case of the soybean rally, that is mostly explained by the conflicts in Argentina? I will talk more about the conflict, but we can start from that.
Yeah, I do. I mean, obviously, the weather in Argentina continues to be a dominant feature, but that's really more about the corn market than it in the soybeans, in my opinion. I think the port strike certainly fed the bull. I think the biggest issue that has continued to feed the bull, other than the trade not knowing how much we're rationing demand by going up straight, pretty much straight up, or a parabolic move higher, has been the fact that we've seen the emerging markets continue to rally against the United States. And so the dollar has continued to go down, and the Chinese currency has continued to make new 2 to 3 year highs. And their stock market in China this past week, Luis, was able to go to its highest level since 2008. So you add on top of that fresh OPEC talks and the OPEC Plus meeting being delayed last month, being pushed into this month, and talk that they may want to cut production again. You've had another breath of fresh air for the commodity bull in that weaker dollar, stronger crude oil market. So to me, instead of, I had felt like going into the January crop report, we get up to around 1260, 1280, somewhere underneath $13. We had done enough until we saw the commodity figures and the USDA supply demand figures for Brazil and Argentina updated. I felt like we had would have done enough at $13 area, 1280, 85 area, but the market wanted to go on higher with the idea that they have not rationed enough demand yet.
Yes, I guess the Argentinian conflict has a lot of potential to escalate because this happened before in 2008 when we had about the same characters of then. They are in power now. The chief of staff of the president at that time in 2008 was the current president of Argentina, and the current vice president of Argentina was the president then. And some things are different. Right there in 2008, there was an attempt to increase export taxes to 35%, and now corn exports were prohibited until March. But as a reaction, producers are not selling corn domestically.
Yeah, and this is really an interesting dynamic because, as we've talked about, my model year is 2007, 2008 because of the price action. The fact that going all the way back to 2000, I can't find where we've had 8 straight months of higher prices in soybeans except for 2007 and 2008. And so now what I'm talking to clients about and subscribers about is exactly what had happened in 2007, 08, and also what happened in 2012, 13, in that in 2007, we went from about $8.40 in August of 2007 up to about $16.60 by July of 2008. And so within essentially a year or 11 months worth of time, we had been able to rally 200%. And so then You look at 3 months later, by October of 2008, we were back trading at 8.25. We had taken out in 3 months' time, or in 25% of the amount of time that it took to rally the market, we had pulled all of the premium back out of that market. The same pattern was seen also in 2012. And goes back to what I think we've talked about before. I don't like these straight up parabolic moves where we cut demand off at the knees, and the demand is rationed so rapidly that it doesn't come back. And I think we're doing that in beans especially. And I think to a lesser degree, we're starting to do that in the ethanol market for corn. A couple other statistics or numbers that I think your listeners will be really interested in. And this goes back to what is a better commodity to sell, corn or beans, which has a better value to it, which has more support to it in the long run. I've looked at Chinese futures for soybeans, for soy meal, and for corn and compared those to what the price is at the mercantile exchange or the United States futures. For both meal and soybeans, we're about $50 a ton lower than Chinese prices right now. So we have done a lot of catching up to Chinese prices. For the soybeans, we're trading about $550 a ton in China's Dalian exchange. Here in the United States, we're trading about $535 a ton. So even tighter for soybeans. Meals more like $50. The corn, though, is a whole different story. In China right now, we're trading at around $420 a ton, which, Luis, that ends up being about $10.70 a bushel. That compares to our price at the mercantile exchange of about $195 a ton. So we are more than half below the price at the mercantile exchange still, compared to China when it comes to the corn market. So I continue to like to sell the beans, wait for a pullback. I think that pullback will come this month still and probably come around the report. But for the corn, if I sell, I really want to buy back relatively quickly.
Yeah, the another question I was going to ask you if there is a growing temptation for more speculation.
Yes, and this speculation comes historically, and it's very logical, especially after 5 years of lower prices. I had a great conversation with a very good client in Illinois today or yesterday, and he and I were talking about selling some new crop corn, and he said, "Well, I'm waiting for $5 for December futures." And I said, "Will you sell it there, or will you raise your price to 550 when it gets to $5?" And he just started laughing because that's essentially where we're at right now when it comes to the farmer seller. And I think you have a really big point, because it's not just happening in Argentina, but it's also happening in Brazil. It's also happening in Ukraine. It's also happening here in the United States. And this is part of the reason why the market continues to go straight up, to get supplies out of the farmers' hands. But by the same token, we're really hurting the demand base at the same time, I fear. And that's why I really don't want to let go of these prices, because, as I said a minute ago, you can go 11 months higher and get kind of lulled into that 11 months after over and over and over again going higher and higher and higher. Then all of a sudden the market breaks and you stand back, and 2 months later you've lost your whole rally. That happens in these markets, and it happens more often than not. So I'm really getting eager to get prices locked in for producers, and then formulating defensive reownership buyback plans that I think will keep them in the game and make them very happy at the end of the year.
And given this complicated scenario, do you think it's recommended to anticipate planting decisions or not?
Yeah, I mean, what I'm hearing consistently throughout the month of January is, because the bean corn ratio, the producers are really going hard after soybeans. And so you really lay the groundwork that if you recharge moisture levels in the middle part of the United States, which we have been doing this past 2 or 3 weeks, if you recharge these adequately going into springtime, where will the La Nina bulls be? And that's a really big question in my mind. That's why I like the defensive tactic and the reownership tactic so much more, because I don't have to worry about the weather. I'll be there if it stays dry or if it turns off very dry after planting. But I think this really begs the question is we've got a lot of bullishness in this market coming from the La Nina and the investor sentiment that the supplies are going to continue to be cut and reduced because of the weather pattern. Yet the Bureau of Meteorology in Australia is suggesting that this month could be the peak in the La Nina. So I think what I'm saying in the United States, at least, is that we are getting more precip across the middle part of the country than we were in November or in October. And I think when I look at everything on the table, I'm not trying to talk a market down. What I'm really trying to do is objectively analyze those features and those fundamentals that took us to get to this point. Are they still with us? Are they still underpinning us? And once I see the USDA report and I get an idea of how much we're rationing demand, I think it'll be really, really useful to really reevaluate positions for clients. And one last thing, back on the Argentine situation, the USDA attaché just came out before we went on the air today and gave an update on the oilseed production estimate. Well, they're talking about timely rains coming in for soybeans, and he lowered his production down to 50 million tons, which is where USDA was this past month. So I think it's very odd that the USDA attaché is, as of December 29th, still looking at about the same production level for soybeans that they were officially a month ago. Do you see that crop being able to hold on like that from your contacts?
Yeah, so I think that will be tough to get a very strong soybean planting here in Argentina, and yet I see farmers a lot talking a lot more about this conflict with the government than about the weather.
And it would make sense that the government would probably put more of an export tax or levy on wheat and corn as opposed to soybeans, because you usually crush the soybeans to send out as meal as an export. Is that right?
Yeah, that can happen. But as you mentioned the fundamentals, I would like to ask you an update on what you think about the U.S. dollar. As on the last show, we didn't enter a lot into this issue.
Yeah, this has been a really good canary in the coal mine, as we say. It's been a good leading indicator to whether the inflation bull will stay in the commodities and even add to their positions. And we've seen that in the Commitment to Traders report, because the dollar stayed weak and the crude oil stayed strong. And in fact, the relationship between those two on a 12-week basis remains over 90% positive, or excuse me, 90% negative. So one moves almost in the exact opposite direction as the other. As far as I'm concerned, Luis, we're biding time with the Georgia runoff election now in the books. And we see that the Democrats probably have gained, and we have a new president coming in place that has a platform or an agenda of higher regulations and higher taxes. I think the market is going to have to reevaluate where they're at in an inflationary bias, because higher taxes and stronger regulations tend to be deflationary, not inflationary. And I think that creates more support for the US dollar as we get deeper into 2021. I'm not sure the dollar will give a buy signal before the end of January, but I think by the end of the first quarter, I'd be looking for the dollar to start going up again against the Chinese currency and against the Brazilian real. So that has been a major foundational element to why we've seen such a sharp rally and why it stayed so strong and dips have been bought. So that to me is the biggest leading indicator as to maybe the potential for the very end of the rally potential in the grains.
Do you see a reversal from the trend that Brazil is more expensive than the U.S.?
Yes, in fact, the U.S. soybean prices at the Gulf of Mexico, I looked at those before we came on the air, and if I remember correctly, we are now running about $10 to $15 a ton over the export price in Brazil. So we have done the job of catching up to the Brazilian prices very adequately. And I would think that the soy meal prices too, given the crush margins that we're looking at right now, soy meal prices too are probably rationing demand as well. We know we're seeing demand rationing in the export market by the export sales pace we've seen so far to date. We still see a pretty strong domestic crush market, but that's probably going to taper off as we get into the March, April time period because the livestock numbers will start declining pretty quickly in terms of the hogs, especially. The Department of Energy came out with fresh energy numbers for 2020, and they showed that the all products, unleaded gas and diesel and distillates, all product demand for 2020 was down about 12% year over year versus 2019. USDA Department of Agriculture also came out with fresh numbers and showed that the overall ethanol crush for November was down about 5.5%. DDGs down 4.5% in November versus November 2019. So we are seeing rationing at this point. I've also heard reports now that the oldest ethanol producer in the U.S. Is in Cedar Rapids, Iowa, is expected to shutter in the next 30 days. And that makes sense because some of the numbers that I'm looking at right now suggest that in that part of Iowa, ethanol margins are a negative 30 cents a gallon right now.
Yes, and how do you think all of that is going to affect wheat that you have been talking that is the lead commodity for the coming months as it happened in previous months?
Yeah, this is where the wheat, I think in the short term, probably is going to be more of a follower. And it would make sense to me that the corn can stay stronger relative to the wheat unless we stay dry in Russia and here in the United States. Like I said, there have been areas of Kansas and Oklahoma and Texas, major wheat belt areas that have gotten 12 plus inches of snow over the last 2 weeks. And so we have done some good in alleviating some of the drought. Russia is still looking very dry. Ukraine is still on my watch list. But I think generally speaking, in the short term, we need the corn acres to be bought against the soybeans. And so I think corn could divorce itself from wheat for a 30 or 60-day time period. But when we come back into the spring, if we're going to have a move back up that's meaningful, I think wheat continues to be our leader to the upside because that's where the tight stocks really need to be seen. And the drought needs to be seen to make the market feel as though that we don't have sorghum, we don't have wheat, we don't have DDGs. And that gives the corn the upside potential because it's the substitute for all those others.
And you see also a consumer trend that has changed in terms of human consumption.
Yeah, and this goes back to the COVID. Our death rates in the United States, they go back and forth, but the hospitalizations continue to make record highs almost weekly. And I think that really takes away from the labor pool. And I think I've got confirmation from one source that other countries have been buying extra in terms of grains, getting grains on the water and getting them to their ports because they're worried about these COVID spikes. And so here again, we've got some demand that's been pulled forward because of COVID, Louise. We just don't know how much of a hole in demand we're going to have in, say, 60 or 90 days. So what I've developed for 2021, generally speaking, is a pretty simple plan. I think the best time for the grain market rally is the first half of 2021 calendar year. And then with lower weights because of higher grain prices and lower breeding inventory numbers from this time period starting to show up as we get into May, June, the livestock futures and the livestock hedgers probably have a more optimistic hedge window the second half of the calendar year of 2021. So in my very oversimplistic mindset in that relationship is I really want to hedge hard in the grains the first half of the year and then be more of a cash marketer when it comes to the livestock the second half of the year.
And how complicated is the life of a livestock producer right now?
Very complicated because you have the cattle market cannot get established here in the United States. The Fed Cattle Exchange had an operation today and nothing got sold. It seems as though you can't break through $1.10 on fat cattle. And last year at this time, I think we were at $1.24. So we're really down on about the same amount of production. And that goes back to the COVID, and it goes back to competing supplies. And I think this is where, unfortunately, cattle are being led by the equities markets. They're being led by the hog market, and they're being led by the feeder cattle market. One thing I'll point out to some of the people that work with feeder cattle and that work with calves, because that's an important time right now for whether you're buying calves and you're going to keep them in the spring or let them go as heavier weight calves this spring, is the feeder cattle minus the fat cattle spread is down to about $20. That's close to, it's about $4 to $5 from the 2020 low. So the feeder cattle are very discount to the fat cattle, and I think this is because of the corn and the corn market being bought and feeder cattle being sold by the funds. So I'm really eager to put in a buy position for the feeders if I can get those down a couple, three more dollars, or in the next 30 to 45 days.
And don't you see more volatility because of these higher meal prices?
Yes, and you have the DDGs also creating more volatility because there are ethanol plants, as we've talked about, and especially west of the Mississippi River here in the United States, that are not giving bids past February or past March. So all of a sudden, your dry distiller grain supply for your cattle lots, you can't get it. And so you're going to have to go in and find some kind of alternative. So you are going to have, I think, historic volatility between the macro side of the equation, the politics, and then we haven't even talked about what China may want to do as the springtime comes around, and with their holiday, coming up as far as their Lunar New Year, that's right around the corner as well. So expect continued historic volatility in these commodities.
So what would you like to highlight in a nutshell?
I think in the nutshell is go back to and look at corn and bean and wheat charts, and very sharp rallies are met with very sharp sell-offs that happen even faster. And it may not be this way this time, but plan on it being that way so you're not left high, as we say, high and dry. And I think that would do very well in your marketing plan.
That's great. Thank you, Mike.
Thanks, Louise.